the Forex daily market cycle. Now, guys, important to understand that this information is highly classified information. It was never supposed to be revealed to the public until now. We are here to expose it. Now, if you guys didn't know already, this market is highly centralized, manipulated by central banks, algorithmically designed, so everything is predetermined, which is scary, but also very relieving, because now with that information, we know that we can understand the algorithm and understand the moves of the market. So in this session, we're going to be showing you guys the Forex daily market cycle, how the market cycle repeats itself based on the principles that it has, and then how to actually use that information to become a profitable trader. So guys, stick around to the end of this video, because by the end of this video, you're going to have all the information on the market cycle, how to use it, and most importantly, we're going to be breaking it down into 2 trades that are going to hit a series of 15 risk to reward. If you haven't already subscribed to the channel, do go ahead and subscribe to the channel so you guys can be alerted whenever we do post videos. And just subscribing to the channel helps us in general. It actually motivates us to post more videos. So if you want more videos on this channel, you should subscribe. So starting off with, how do we determine the market cycle? How do we understand it? So there are 3 main sessions to take into account. We have Asia, which is represented here in blue, A equals 59.7. The number value is the total amount of pips moved in that session. Then we have in green, London session. Then we have in pink or red, New York session. So how you're going to get this is you're going to go to indicators. You're going to type in Asian, and it's going to just come up automatically. Asian session range, FXN, I use Rob Minty. You want to highlight it, make it a favorite. Then you're going to have it, you're going to have to actually program it just by double clicking it. And then you'll see inputs, start session for Asia, start session for London, start session for New York, and end. So you're going to have to go into, Safari or whatnot to find out what session starts and finishes when. Put that information in and you'll have this. So there are essentially core principles. The core principles are that there is liquidity at the highs and lows of every session. So every session high and every session low is a huge pool of liquidity, which is always ran by the next session. Now, dependent upon, who's in control, supply or demand, or things like order flow, there will be a overall direction, of course, of where that's going to move. But if, for example, London goes and takes Asia highs, then the next session will likely go and take London lows if we are, moving to the downside, which in this video we are. So there's liquidity at the end of every session, highs and lows, and the next session is going to take a level of liquidity. If that session doesn't take a level of liquidity, then likely that session will have both of its highs and lows taken, as you will see in this video. So breaking it down and actually putting it into context to actually be able to take a trade, right? So I'm going to start off here and I'm going to show you, we see Asia highs get liquidated over here. London doesn't liquidate Asia. Asia has already been liquidated. Usually what will happen is between Asia and London, Asia high or low will be liquidated. So you can see here we have the Asia session. Here we have the London session. Before London opens, Asia's already been liquidated. Now, usually the common rule is once a side of the market gets liquidated, it will likely run and turn the other way because the liquidity has now been taken on the one side of the market. So the only liquidity available is, of course, on the other side of the market. So when we see the Asia highs get swept, you'll see that we start reversing. And London comes up and starts reversing. Come into New York. New York takes what? London lows. And then does what? Reverses, right? Then Asia opens and does what? Takes the previous day's highs because all the lows have been taken. Takes the previous day's lows then after. Reverses. Comes back up. The session in between Asia and London does what? Takes out the lows. And then what? London opens and pulls back the retracement because there would have been so many inducements. Now the liquidity lies on the top side. Last session doesn't take the lows of the last session. So Asia highs get swept, so does the previous high. Now, for anybody who can see this price action right here, you'll see that this buy to sell in London is very clear manipulation from the banks, right? You can see the huge impulse to the upside and then huge impulse to the downside straight away. What is that a sign of? It's a sign that all the liquidity has now been cleared to the upside, so the only liquidity available now is to the downside. So essentially, anybody who understands our supply and demand models understands that supply levels are created from buy to sell moves that essentially take levels of liquidity and leave behind orders that aren't able to be filled in that exact area. That's why price comes back to them and then moves away from them. So when London had this huge manipulation and give us the incentivization that price was going to continually decrease, which we can understand how, well, let's zoom out for a second. We can see that the highs were taken here. Where were they taken? They were taken from this low. These lows took this high. Then we had the shift, right? So there's our break of structure. Here was our supply level. Now our supply level gets slightly liquidated. Okay. And then what caused the liquidation? Well, here's the low. When this goes, that's our break of structure. So we now know the order flow, the trend is shifting bearish. So we are anticipating shorts from areas of supply. Very simple to understand in context when you actually put it all together like a puzzle. So after the London session, you can see New York starts retracing, doesn't take out the high and doesn't take out the low, which usually means that both the high and low of New York will be liquidated. As we can see, the day after, Asia liquidates the lows. Now, usually when Asia isn't representing a swing high, so it's in the middle of a range, likely it will get swept both sides. So you can see that we sweep the highs and we sweep the New York highs from the previous day. However, we don't actually get tagged in to our entry. So yes, we would be having an entry on here because this is where price is likely to come back to and just continue the trend. We can see that this low right here has put in a high that has failed to break it, making this a weak low. So if we just trade in structure, which is, this low put in this high and that low got broken, we're expecting just to see this. Literally, that's what we're expecting to see. So if we just slap our order on here, and we just even cover the highs, which is a 21 pip stop, and then we take out the lows for our first day profit. Down here, we take out these lows. Why? Because this is a weak low. It's an Asia low. And what do we know? If we just zoom out to the right-hand side, we will see that over here we have what? Tons of built up liquidity on the lows, right? We have the London low, we have a Asia low, and we have another Asia low. And so we have a ton of built up liquidity in these areas. And so it's a great place to go to because that's where the liquidity is. All the liquidity on the buy side has now been taken. So the only levels of liquidity that remain are on the sell side, which is a reason for the market to go down. Now we can see that we don't actually get tagged into our position. So that, as you can see, I know it's not very clear to see, is a London high. So this high hasn't tagged in, so we could use that as a level of liquidity. So we could say now that we have our liquidity forming, that's going to enable us then to get into our position, which is in here. If we just move this over, this would be our entry and this would be our take profit, just based off structure, right? And then of course our area of entry is from a supply zone, which is important. So let's play price and see kind of how it plays out. So you can see a big impulse move, which is what? Just after the Asia session. Asia session finishes and then we sweep the high. As we said before, again, between Asia and London, you'll see a sweep and then likely a reverse. So we've had the sweep to the highs. So now we could be anticipating the reverse. So you can see we don't get tagged in again, but what do? We build perfect liquidity. Now we have perfect double top, which retail traders are looking at this, and that when you see price push away from the area, what are they expecting? They're expecting price to then decrease because they're seeing double top respective decrease. Okay, now they're going to be looking to get involved in the market somewhere, around here with their stop losses just above this double top, which is exactly what? Our entry, which is perfect, right? So just play price. Okay, they get tagged in and tagged straight out. And so you can see the sweep, the run on the highs, right? Just as what? London is about to open. So we'll see now likely the reversal in London. As London opens, you see it hovers around, and then we get the sell-off, the start of the reversal. But what have we also done in here? We've taken the highs. Here's the demand level that's taken out the highs. When that level gets broken, that is our change of character, which further confirms that there is more supply than demand, which enables us to get involved in another entry. Because we already have our narrative, we already have our bias, we can put our stops just above our current entry. We can take out these lows. Okay, build up liquidity. Building up more liquidity, building up a lot of liquidity now in this area, which is perfect, just before our entry, which is always essentially what you want. I just won't merge them yet. Then we can see what price hovers around, price tags us into our positions. When? When New York starts. So we have an unswept London low, an unswept Asia low, and all of this liquidity to here. Another unswept London low, another unswept Asia low. And what are we also starting to form? A trend line to the upside, which is what? More liquidity. So liquidity is the cause and effect model of the market. Essentially, liquidity is the reason for price to go in a certain direction because the market is programmed to go to where the liquidity is, end of story. The market's purpose is to go to where the liquidity is. And in doing so, of course, it creates liquidity. So we have all of the confluences that would give us the belief that the market was going to the downside based on the liquidity, right? And as you can very clearly see, then our take profits get hit. And so that is exactly how to use the Forex daily market cycle in alignment with our other concept of supply and demand and market structure to actually position yourself in the market with the banks instead of against them, which most people do. So guys, that brings us to the end of the video. If you guys did enjoy that video, do go ahead and like the video.